What's up, guys? How we doing? Let's talk about the cash secure put, also known as the CSP, and why right now that is my primary option strategy that I'm using, why I've kind of gotten away from the poor man's covered call and leaps options right now. While I'm not really wheeling, I am starting with the cash secure put, and there are some reasons. I'm going to give you a quick breakdown of what the CSP is in case you've never heard of it, give you the pros and cons and how that led to this decision of using them right now. Maybe we might even be able to make one today. I've been watching a stock. Maybe we'll make one live. As well as show you my spreadsheet of all of the puts that I've made this year, the returns that I made, the annual returns, how much premium. Like I said, give you a pretty good picture of why the cash secure put really it's kicking ass right now. So first, a brief rundown. If you are new to my channel, I have made a couple different videos. I try and update them like every 6 months. So this is kind of the updated version of the CSP, but I've gone deeper in depth. I'll leave a card somewhere. I'll leave it in the description. I'll pin it in the comments. So if you want even a further in-depth view of the CSP, you could do that. Essentially what it is we are going to be using cash as collateral to sell a put option, aka write a put option, at a strike price of a fair value that we kind of want. Have you ever said to yourself like, oh man, I would love to own this stock, but I wish I could own it at a lower price that was 10% lower? That's what the CSP does. It gives you the opportunity to buy a stock at that particular strike price that you choose. That's one of the pros of it. So that's essentially all we have to do. We have to decide a stock that we really want to hold on to, that we'd love to own 100 shares of, and then kind of pick the price at which we would want to own that for. And if the share price falls below our strike price at expiration, then we have to buy those 100 shares. If the stock price stays above our strike price, then we keep that premium that goes into our pocket immediately upon fulfillment, can never be taken away from us. We go out, we buy some beers, money in the bank, shorty what you drink. You can do whatever you want with the premium. Now, when I first started trading the wheel strategy, I always put the cash secure put second. I always wanted to start with the call. And one of the things I've said to myself, and I've heard other people say, and the reason why I kind of avoided the cash secure put, is we said this thing called, oh, we have to tie up all this collateral. Writing cash secure puts is pretty expensive, right? Because if the strike price is, say, $50 and a contract is 100 shares, you need to put up the amount of money to buy those 100 shares. All right, now you can do it on margin. There's things called naked puts. That's not really my style. So in this case, I'm saying if I want to pick a strike price of $10, that means I'm going to need $1,000 to put aside as collateral in case I do get assigned and have to buy those shares. And I hated feeling like that collateral was just sitting there, not making me any money, but in a sense, it made me money right up front. I didn't even have to wait for it. So in a sense, it was actually almost better than owning the shares. It wasn't until I looked at the math and saw like my returns on investments inside these cash secure puts that made like my life so much easier. And also with the call, I always found it easier to pick my strike price, right? When we write calls, it's just easy enough as just what is my cost basis, the average price per share, and then I just have to make sure I'm above that to make money. Well, when I was writing CSPs, right, we don't have a basis necessarily. And if you don't know how to pick the fair value of a stock, which I am going to make a video on very, very soon. So subscribe, hit that notification bell if you want to see how I find the fair value. But if you don't know how to find that fair value, it can be very, very hard to find the strike price unless you do math and you look at some of the returns on your investment. How much collateral do you put versus how much premium do you collect? If you've ever heard the expression, don't be the smartest person in the room, why I got into CSPs really is that. I started hanging out in rooms with people that were a lot more wealthy than me. I got into masterminds. I started making phone calls. I got into groups. I got into discords. And I found out that people that were much wealthier than me, that's really what they were doing. They were taking a large amount of capital and they were writing puts with it. And I was like, well, if all these wealthy people are writing puts and they're not doing leaps and buying poor man's covered calls and all these other different stock things that we could do, they were just writing puts, picking prices that they were willing to buy stocks at, collecting premium, and that was that. I said, all right, well, like I said, they're doing it, so I should probably look at it too. And then just my mind was blown when I started looking at the math. So first they're sour, then they're sweet. What are the cons? The cons here, is that collateral. You need to have enough cash to purchase 100 shares of that stock. So if you're looking at something like a $100 stock, you need $10,000 to put aside to make that particular put. But if you are able to do it, you'll see by the math I'm going to show you in a second that it is well well worth it. The other con is you do not collect dividends like you would if you were writing covered calls, okay? Because in that case, you own the actual stocks even while that contract is open. In this case, you don't. So not really a great play if you're like looking to get dividends. And the last real big con is that the stock price could tank, right? And you could be smacked and you could bag hold. And if you've been doing this for a while, it's happened. It's happening to me right now. I'll show you what I'm getting smacked on right now. I have a put that is going to be assigned, and I'm going to be bag holding it for a very, very long time. We'll get to that in just a second. So what are the pros that I see? Once again, it's an immediate return. You don't have to wait. You can calculate exactly what your return is going to be today. So it's an immediate return on your money, immediate return on capital. That is probably the thing that I've liked the most about it. Second, you get to pick the price at which you buy those 100 shares. Now, if the share price never falls to that strike, yeah, you may never get to actually purchase the stock at that price. But while you're waiting, you're going to be collecting premium the entire time. So that is just awesome. And you could still be kind of bullish on a stock, and this offers some amazing downside protection. If it's going up or it's kind of like a steady mover, you can write this put in case it dives down. Then you get the shares at a lower price. That's going to lower your cost basis. So you can also use this as an amazing way to protect yourself on a downside correction. Quick little pro tip, guys, if you are going to write puts, do it on a day where that stock is in the red. When the price of that stock is falling, that's when the premiums are going to be the highest. Write covered calls on green days for that stock and write puts on red days for that stock. Before we take a look at my spreadsheet, guys, let's take a look at the options that I have open. I'll just show you the puts. I have a bunch. You guys can follow along for everything else or jump in the Discord. But here's what I was talking about, this Peloton. I'm going to be bag holding this for a long time, most likely. I have a put for $54, which I'm very happy paying. Like I said, I picked a fair value that I was happy with. It was right after earnings. It shot down. If we look at Peloton, what it did last week, it just fell off a cliff. I don't think personally it's going to continue to fall off a cliff that bad. So I wrote a put. I collected a pretty good premium off of it. Not too bad. Let me see if it shows it. If we see down here, I got $179. I wrote another one that expired last week. So just on that downturn, I made $200 pretty quickly. And like I said, I have a feeling now, after watching this a little bit longer, it's probably not going to bounce back up over 54 by the end of the week. Well, do I think it'll get to 54 eventually? Yeah, I think it's going to get back up to 54, but I'm going to be bag holding this for a little while, and that's something that you just need to be prepared for if you are going to write puts. You have to be prepared for that stock to plummet way below your strike price and then not be able to necessarily write calls against it to get some of that premium back. This will just become a wheel stock for me, and it's not going to be that big of a deal. You have to be emotionally prepared for that. This is a buy put, so that's a completely different video. I also have sold puts on Vuzi. I have a $10 put on Vuzi right now, and also CCL. I have a $20 put. And as you see, the point that I want to make by showing you these ones, guys, these are far out in expiration. When we think of the wheel strategy, we think of just writing things every single week. We get the next expiration, we collect the premium, and go. And that was another reason why I didn't really like puts that much, is because I saw people writing them out long term, and I was like, why would you tie up that collateral for 6 months? As we're going to see in a second, what I realized is I could pretty much say at the time that March 18th is 6 months away. I have to just take the premium that I collected, divided by the collateral, multiplied by 100, and know that that is going to be the return on investment regardless of what happens, even if I were to get assigned. And I don't care about getting assigned because I picked a price that I wouldn't mind owning the stock at. Let's hop over to my spreadsheet, take a look at that math. I'll say it a little bit slower, and then we'll come back to Robinhood and see if we can write a put right here in real time. If you've been following along, you guys know I track everything. If you want access to these spreadsheets, obviously, you know, they're inside my Discord. Here's all the wheels for the year, okay? But what I did was I just separated the puts from the calls just so we can look at just the puts that I've written this year. And they've definitely picked up in frequency. We'll see pretty much between January and July, I didn't write any. Wasn't a big fan. You are allowed to change your mind. You are allowed to educate yourself. You are allowed to change strategies with different market conditions. That's why it's good to know how to do a bunch of things, because market conditions change. Right now we're in this like weird little like flat, maybe even down market. It's a great time to write puts. That's why I'm doing it. I'm not doing the leaps option, not because I hate leaps and I hate the poor man's covered call, I just don't know what the market's necessarily going to do over the next 6 to 8 months, and this feels a little bit more secure for me. So I think the really important columns here, guys, are the net premium and the collateral. That's kind of like where the math starts to finding this ROI. All right, so this ROI column over here is simply found by doing this. I take the premium that I collected that goes into your bank account immediately, does not matter what happens. I divide it by the collateral and multiply it by 100, okay? You could just see M52 divided by N52, and I made this a percentage which calculates it automatically by 100. So I knew that for this transaction, before anything is done, before expirations, before assignment, before anything is done, I made 2% on my money. Now, 2% doesn't sound great if it's over the course of a year. 2% doesn't sound awesome even if it's in the case of like maybe 6 months or so. So that's why I look at the annual return on investment as well. The return on investment, I don't particularly look at as far as like whether I should make this trade or not, because like I said, the annual return on investment is really the thing that I'm going to be looking at when I'm like, okay, that's good to go. But if you're curious, per trade, I pretty much average right now 3.4 to 3.45% every single trade. Some of them are as high as 10, some of them are as low as under 1. Okay, but the average about 3.4. So I know that could give me kind of like an initial like filter. If I take the net premium and divide it by the collateral and I don't get somewhere around 2%, this might not be a good deal for me unless I'm going pretty far out into expiration. And we'll see some expirations in the 2022s over here, but guys, those are all in the Fidelity portfolio. My buddy JJ Buckner and I, we opened a portfolio with our podcast, Average Money, but then we had to close down that portfolio because we needed the cash to buy real estate. So I had these goals of going out this far into 2022, but I just had to close them. But we see I still made pretty good returns even in the short time that I had them open, 61 days, 54 days. I average right now about 23 days for all my puts for the year. That's how long the averages that I've had them open. That is much different than with my calls. My calls, I mostly sell weeklies unless I have to sell monthlies. Puts are being pushed out. I'm kind of doing them in 3 and 6 months intervals, and I'll tell you why I do that when I talk about the annual return on investment. So now as far as the annual return on investment, I'm sure there's different ways to do this. I kind of just came up with a way that made sense to me. You can leave in the comments if this is completely whacked and like I'm giving false information. I don't think I am. But essentially what I did was I looked at the length that this option was open. So this option right at the top, this TCCF, it was open for 4 days. So if I made 2.35% in 4 days, the way I figure out my annual return on investment, I say, all right, if I did that in 4 days and I could do that every 4 days, how many times can I replicate that throughout the entire year? For an easier math, if I wrote one for 6 months, I would just have to take the ROI and multiply it by 2. That's why I kind of like 6 months, because it's easy to do math. If I do a 3-month expiration, I take the return on investment and I could quickly just multiply that by 4. Now, I know the return on investment police are going to be like, well, you'd have to duplicate it. The likelihood of duplicating it every 4 days, Brad, is yes. Guys, these are rough numbers. I probably won't return the 100%, the average I'm doing right now, but it at least gives me a framework. If I get a 278% that I get for the math, and I can only duplicate that to get 27%, okay, I'll take 20% annual return on investment, no problem. And once I saw this math, once I said to myself, wow, that the market returns on average 8 to 10% every single year historically. If I can write puts at a price that I like and get myself 12 to 15% right there and then, why would I not make that deal? I wouldn't have to wait for the stock to go up. I wouldn't have to reinvest my dividends. I can strictly just use math and say, hey, I like the price. I like the strike. Let's get some premium. It's a guaranteed annual return on investment. That's really why I want to make this video, because just do some quick math and it's just like, yep, I'll take that deal. I'll take that deal all day. So the ones I still have open, I don't have annual returns for because I don't have the length that they're open. But we could see 100% return, guys. Some of them are up higher, some of them are up lower. But like I said, is this 100% realistic? No, it's just a framework. Even if I just do 10% of that and get a 10% return, I'm still good and I don't have to worry about any market volatility whatsoever. So now let's put all this to practice. Let's jump back over to Robinhood and see if we can actually make one. I got about $11,000 in buying power right now. So with $11,000 of buying power, I know that I have to pick something that's under $110. I don't want to clean out my buying power because I like to buy to close on all these other options. So I'm thinking, okay, maybe I have myself about $5,000. So I can look at stocks that are pretty much $50 and under. Okay, I have a watch list, so I'm going to look at some of my stocks that are $50 and under. I know that I want to write puts on a red day because that's when the premium is the best. And then what I'm going to do is I'm going to look 3 months out and see what those returns kind of look like. Then I'm going to look 6 months out, see what those returns, and if they meet my criteria, like I said, annual return on investment, if I can make 12 to 15%, I'm probably going to do it. I'll kind of think out loud as I'm doing this. And if you have any questions about what I did, if I skip past it, just let me know down in the comments below. So coming down here to my watch list, guys, we have Foot Locker we can look at. We have Peloton. I already have one out, so I'm probably not going to mess with Peloton. I could possibly do one with Uber. Coca-Cola is kind of at the top end. All these other ones are green. Tattoo Chef, I could kind of look at Tattoo Chef. SWBI, we can kind of look at that. And these ones down here, Cisco, Starbucks, those are a little bit too expensive for me right now. Let's take a look at one of the cheaper options. I already have some things going on with Tattoo Chef right now, so I'm not going to do that one. Let's just look at SWB, okay? This is Smith & Wesson Brands. I'm going to go to trade options. I'm going to make sure I put sell, put, and I'm going to look. I'm pretty sure, yep, these are going to be monthlies. So right now we're essentially right here. So if I go 1, 2, 3, I get to March 18th, 2022. Then I start to look at the premiums and the volume that these have. Obviously, closer to the money, the premiums are going to be a little bit higher. I kind of want to make sure that I have a delta that's about 2 or less. So right now, this is pretty good to me. Why that delta of 0.2? Well, the delta is roughly the buyer's likelihood of success or profit. So if they have a 19% chance, that pretty much gives me an 80% chance. Now what I'm going to do is I'm going to do some math. I'm going to get $88 for this trade, and I am going to have to put up $1,750. So handy dandy calculator, boop, boop, boop. Let me plug that in quick. 88 divided by 1750 times 100 is going to give me a 5% return on this right now. 5.02%. Now this is 3 months out. So if I could duplicate that every 3 months, I get one double to 6. Then I get another one. So I can multiply this by 4 to get my annual return on investment. Boom, 4. That's going to give me a 20% return on my money right now. Worst case scenario, I get Smith & Wesson, a brand that I'm already think $21 is a good price. I will definitely take it at $17.50. And now the price just went up because this thing keeps diving down. So right now we're at $88 once again. What I'm going to do is I'm going to press go. We are going to do this deal. I want to get 5% on my money right now. I'm going to press continue. Now you'll notice here, guys, this says 88 and this says 85. SWB is one of those stocks that only trades inside 5-cent increments. So I'm going to press review order. I'm going to press submit. We'll see if we can get this filled. And I put that in, guys, and I got that filled immediately, $85. I'm going to take a screenshot because I'm going to put this right into my Discord. A couple things that I definitely want to notice. I just realized that March 18th, guys, is not 3 months away. There was no February option, so there's no volume for February. So we really have December, January, February, March, okay? So that is going to be 4 months, so I just have to multiply that 5 by 3. Still a 15% return. I'm still going to take that all day. Going back to my portfolio, here it is down here, guys, and it's really as simple as that. I just made 85 bucks. Here's that video I was referencing before about a deeper look inside the cash secure put. If you want to take a look at it, I'll also post something with the covered call in case you are looking into the wheel strategy. Until I see you guys on the next one, stay positive, work really, really hard always. Please be kind to other people. Hope you have yourself an amazing day and even better tomorrow.